Hey everyone, and welcome back to the Finance Zone. There are plenty of questions that investors are pondering as we head into March. Are we at the beginning of a corrective phase in the market, or is it time to buy the dip? Will the sell off in bonds stabilize, or should we anticipate more downside? Can the government get a stimulus bill passed before the expanded unemployment benefits run out on March 14th? All of these things set the backdrop for March to be a fascinating month in financial markets. Choosing the best stock to buy today depends heavily on your personal financial situation. While keeping these questions in mind is important, that shouldn't stop investing from seeking out high quality stocks that can deliver strong alpha during March and over the long term. Many companies have pulled back from their highs or are exhibiting relative strength in a weak market, which means that there are some good buying opportunities to consider. CarParts.com. 2020 was a great year for e-commerce stock thanks to the pandemic, and CarParts.com was among the big winners, with shares up nearly 500%. Even with the economic reopening coming up, however, 2021 looks set to be another strong year for the auto parts retailer. First, the opportunity is more than just e-commerce play. The company is in the midst of a turnaround that began in 2019 when new management took over. Under CEO Lev Pecker, CarParts.com has jettisoned underperforming brands and consolidated the company's operations, which had previously included banners like J.C. Whitney and Auto Parts Warehouse under the CarParts.com brand, making marketing and brand building much more efficient. It also changed the corporate name from U.S. Auto Parts to CarParts.com. The turnaround initiatives, which also include opening new distribution centers and upgrading its tech infrastructure, are delivering results. Gross margin has increased for 6 quarters in a row now, allowing the company to reinvest a greater percentage of revenue back in the business, and e-commerce sales jumped 105% in the third quarter. A number of macro factors are supporting the company as well. Auto parts sales are traditionally strong coming out of recessions as consumers delay buying new cars, and the spike in used car sales during the pandemic should favor auto parts sales, as will the increase in vehicle miles once the economy reopens. Starbucks. New York Stock Exchange SBUX. It was impressive to see Starbucks make new all-time highs during a volatile period in the market, and there are several reasons why investors should consider adding shares of the company in March. As the world's leading retailer of high-quality coffee products, this might be one of the best reopening trades to consider. While Starbucks continues to deal with uncertainties related to the impact of the pandemic, the company has steadily opened new stores, including 278 net new stores during the most recent quarter. This puts the company in a strong position to hit the ground running once the vaccine has been widely distributed, especially since a lot of the smaller coffee shops around the U.S. have had to close during the pandemic. In the most recent quarter, Starbucks management reiterated its fiscal year 2021 guidance, which includes 2,250 new store openings and global comparable sales growth of 18% to 23%. This should help to reassure investors who are concerned about the company's recovery in 2021. Also, it's worth noting that Starbucks continues to adapt to change in consumer habits, including things like mobile ordering app, remodeled stores, and a loyalty rewards membership program. Keep in mind that the company's digital partnership with Alibaba and a global licensing pact with Nestle could provide international upside as well. Etsy. When it comes to e-commerce, Amazon.com, AMNZN, tends to suck all of the air out of the room. However, the shift from offline sales to online sales is so massive that lots of companies are poised to win. Etsy has clearly established itself as one of the e-commerce winners. The company's platform connects buyers and sellers of homemade goods, which is a growing niche that insulates it from other e-commerce competition. Etsy's 2020 numbers show that the demand for the platform is soaring. The company ended the year with 4.4 million active sellers, up 62%, and 81.9 million active buyers, up 77%. Total spending on the site more than doubled to $10.3 billion. Etsy took full advantage of the surging demand. Revenue grew 111% to $1.7 billion. The top-line growth was so strong that Etsy's net income grew 265% to $349 million, even though it significantly increased its spending on marketing, product development, and hiring. Management doesn't think the hypergrowth is ending anytime soon. Revenue is expected to grow at least 125% in the first quarter of 2020, and margin is expected to remain strong for the foreseeable future. MasterCard Incorporated, MA. Another stock that looks primed for its strong March is MasterCard, a company that could have two catalysts working in its favor this month. First, you have news that the leading global payment provider plans to increase its swipe fees for some credit card purchases in April. This is important because even a small rise in the interchange fees per transaction could potentially mean billions of dollars in revenue for the company. You also have the prospect of a stimulus package being passed that could lead to a $1,400 check sent out to millions of Americans, which could certainly be a plus for MasterCard's payment volumes. We know that there's secular growth in the digital payment space, which tells us that a company like MasterCard has a strong chance to reward shareholders over the long term. This is particularly true when you consider the company's potential in emerging markets. Although the company reported a year-over-year net revenue decline of 7% in Q4 to $4.2 billion, the long-term story is too good to pass up here. You also have to like the fact that the company generates revenue from fees regardless of whether a payment is credit, debit, or mobile. MasterCard stock was up 12% in February and could continue to rally on any positive news related to the catalysts mentioned previously. Uber. Uber is well positioned to capitalize on the return to travel and reopening the economy. The company has the unique ability to leverage its two-sided network of drivers and customers into new and old opportunities across its range of services. Other singularly focused gig economy companies don't have this capability. Uber's most valuable asset are its local networks of drivers and customers. Over the last couple of years, management took steps to exit markets where its network wasn't big enough to provide a competitive advantage. It also sold off several non-core assets. As a result, Uber enters 2021 a more focused company with a stronger network advantage. That advantage will come in handy as people return to travel. Most notably, the delivery business ought to act as a tailwind for their more profitable mobility business, as Uber makes it easier for customers and drivers to switch between services. The company has already seen the benefits as management says the ride-hailing business has come back faster than any forms of transportation. Despite the massive downturn in mobility revenues last year, the segment maintained profitable on an adjusted EBITDA basis. The reopening will cause growth in each to slow, but improved take rates and operating leverage should bring it towards positive EBITDA. As a result, management expects the company as a whole will produce positive EBITDA in 2021, as the delivery business seems improved profitability and mobility bounces back. DraftKings. DKNG. DraftKings' impressive Q4 earnings report might have gone unnoticed by many investors that were overwhelmed by the volatility in the market during the final weeks of February. The company delivered year-over-year revenue growth of 146% to $322 million in Q4 and saw monthly unique pay increases by 44% year-over-year. The digital sports entertainment and gaming company is growing at an astonishing pace and is seeing more users than ever before on its product offerings that include daily fantasy sports, sportsbook, and iGaming. Another positive for the company is the fact that Google, Google, announced that it will allow sports betting applications on its store starting on March 1st. Investors should be very bullish on the prospects of companies in the sports betting industry going forward, particularly as more and more states vote to legalize it. The fact that DraftKings boosted its 2021 revenue guidance and now expects revenue ranging from $900 million to $1 billion, which would represent year-over-year growth of 40% to 55%, tells investors that this company is set for a big year. Airbnb. Some investors may balk at the idea of investing in the home-sharing company while they're still in the midst of a pandemic, but there are two reasons that won't matter soon. First, the pandemic will end and travel will return. Second, Airbnb is perfectly positioned to benefit when it does. Travel certainly took a hit over the past year, and Airbnb's revenue fell along with it. The company's sales dropped 22% in the fourth quarter. But you have to put that drop into context. Consider that the company's fourth quarter revenue of $859 million blew past analytics consensus estimate of $748 million. And for the full year 2020, revenue was down just 30% compared to 2019, during a time when essentially the entire world wasn't traveling. With many parts of the US opening back up and coronavirus vaccines being distributed, Airbnb is optimistic that there will be a, quote, significant travel rebound, end quote, this year. And then there's Airbnb's position in the travel space. Airbnb is already a clear leader in the home-sharing market, and once more people feel comfortable traveling again, there's no reason why bookings won't spike for the company. Airbnb offers unique experiences and rentals that can't be found anywhere else, and you can bet the people who've been cooped up at home for the past year are itching for both. Those investors are focusing on Airbnb's $3.4 trillion total addressable market opportunity and understand that the company offers rentals and experiences that its competitors can't match. For investors looking for a unique company that's likely going to see huge growth as travel rebounds, Airbnb looks like a great pick. Remember to check the description and use my Webull referral code for 2 free stocks.